right? That's not very meaningful. Okay, so that's one problem with buying calls. So I decided, just convert to stocks, and ever since then, I've always been a believer of buying stocks. And no, I seldom do options now because I realized, if you go and look at the Forbes 100 list, right? You have look at the Forbes 20 list. There's always we can always learn from success. Success leaves clues, right? You look at these top 20 people, right? They're always either long-term investors or long-term owners of their business, right? Jeff, he actually started Amazon back in the 1990, if I'm not 1997 or something like that, all the way to now. 20 over years holding his company. He's holding his company even when Amazon went down 50% 3 times, guys. His stocks went down 3 times. His stocks went down by 50% 3 times, and even once during the dot-com bubble, it went down by 97%. Right? And he's still holding his company, right? That is the reason why he's so wealthy, right? And could he have done this with call options? I don't think so, right? You look at Bill Gates, also long-term owner of company. Bernard Arnault, he's actually the founder of LVMH, right? Or LV bags, Sephora, everything, right? Long-term owner of companies. Warren Buffett, long-term owner of companies. Warren Buffett does options, but he does put options. He doesn't do buy calls, all right? And, Larry Ellison, all right, long-term owner of companies. Okay, so, I just don't see any option traders on the Forbes 20 list, right? And, that's where I really got this, aha moment that, if you really want to be rich, start buying companies that can grow exponentially, right? That is more what I call permanent wealth, right? Just write this down. You want to really find something that can consistently earn you money and give you permanent wealth. We don't temporal wealth, right? It was nice that I had a 100%, close to 100% gain in my buy call, but was it permanent? No, it wasn't. It was short-lived, in fact, right? So you really want to start asking yourself, right? So this is something that a lot of people don't do, right? I want you guys to print down your trading transaction, right? So I believe if you are using Interactive Brokers or TD Ameritrade, you actually print your transaction history. All right, start going down line by line. Why do you do this trade? Why do you do that trade? Right? Is this something that is going to work out for me in the long term? Right? Let's say if you make a gain, right? Ask yourself, can I consistently make this profit year on year for the next not just 2 years, but 5 years, 10 years, 15 years, 20 years? All right. So this is so important because end of the day, right? For me, I still feel that stocks allow me to sleep well. Stocks allow me to deploy a significant amount of my cash, right? To move the needle in my portfolio without making me lose sleep. So I want to share with you, right? So for JD, right, I actually bought a chunk of it. I made it 20% of my portfolio for, I bought it. My average price was about $24. So actually, I bought calls and also bought some stocks at $40. But I averaged all the way down because I was just so convicted, right? I researched for this company for so long. I messaged the IR to find out about companies. I read every single footnote in the annual report, and I was just so confident. So you can see I got rewarded really well, right? I actually moved 20%. Just one 20% gain, 20% position in my portfolio actually was able to move 20% of my portfolio, right? So this I feel is more meaningful gains, right? Otherwise, there's no way. If you keep holding on cash, you're always scared that something happens. Then you're never going to make good money. Okay, so take note. If there's any good questions along the way, just let me know, because when I'm talking, it's very hard for me to look at the questions because I'm using 2 screens. That's why.
Okay, sure. I will just cut you whenever there's some good questions. But for now, you can continue first. I'll hold on the questions because I think this is great.
Yeah, so I just want to share with you guys, right? If anything I want you to take away, right, it's not the stock tips, right? It's this thing called conviction. Anyone can lend you stock ideas, right? Anyone can lend you stock ideas, but they can't lend you their conviction. Very, very important. And during this crisis, right, I'm gonna ask how many of you guys actually took action, right? How many of you actually took significant action? Just type yes. If you didn't take much action, just type no. It's totally fine. This is a very close group. It's very safe here. It's a very safe environment. Okay, so Joey says no. Smart Fund Hedge Manager say yes. Gabriel say yes. KTL says no. Right. So for those who took action, right, you want to ask yourself, right, do you just take maybe a small position? Right? Do you just take a small position, or do you take a big position, right? So if you didn't take a big position, then you start asking yourself, right, why you didn't do so? And when you ask yourself why so many times, right, you will start to realize that actually, end of the day, right, something about this knowledge thing, right, likely, maybe it's because you didn't dare to put in so much money because it was a stock tip, right? You didn't really understand the company yourself, right? You didn't really look at the investor presentations, so that's why you didn't have the conviction. So if anything, guys, want to take away, right, form your conviction, right? Form your conviction in Microsoft. I feel like, it's so easy to form your conviction in Microsoft. Just go and understand what they're doing, look through their website, right? See what they do, ask yourself, will they be affected during a recession, right? By the way, their clients are B2B, right? They are not B2C, right? B2C, it means business to consumers. Consumers are fickle-minded. In a recession, they lose their income, right? They'll start spending lesser and your business will get hit if you're a B2C company. But for a B2B company, right, Microsoft clients are banks, right? Banks, guys. Microsoft clients are banks, big MNCs, all right? Do you think MNCs will cut down their spending dramatically, right? I don't think so. These are mission critical things. They can't afford, in fact, to cut down their database. They can't afford to cut down on whatever your machine learning or AI or your system of records for banks, right? How are you going to cut down that? If you cut down all this, then you're not going to run your business operations. Okay, so these are the big elephants that are going to rebound, right? So now, I tell you that it's good. It's no use, right? Because what's going to be useful is where, if a recession does come again, there's going to be a fall in stock prices. You're going to then put 20% of your portfolio, 30% of your portfolio into Microsoft, right? Because that's the thing that's going to move the needle in the portfolio, right? It makes no sense. It's of no use. Yes, you do benefit from today's sharing, but you're going to put only 5% of your portfolio, right? Then that's kind of useless. Yeah. So yes, Teco, I saw it. I saw your message. Okay. So now I'm going to share with you another company which I like as well, which is Facebook. By the way, guys, I want to share with you, right? If you have a portfolio of lesser than $10,000, there's no point in buying 10 stocks. Seriously, there's no point in buying 10 stocks because let's say if you buy 10 stocks, right? Okay, let's say you buy 10 stocks. Okay, if one stock, so each stock 10%, right, of a portfolio. So if one stock actually double, right, you're just only going to move your portfolio by 10%, and I think it's quite pointless if you put in so much research work. And at the end of the day, you're only going to put 10%, right? So let me explain why. Because I feel that most of you guys are working adults. You can easily earn back $10,000, right? If you're not managing other people's money, you're not investing on borrowed money, right? So how do you make your portfolio move, right? If you have a 10K portfolio, right, you have to keep it under 3 to 4 stocks, right? Consider that, right? 3 to 4 stocks. I mean, some of you are going to ask me, isn't that risky? But let me ask you, right? If you have the choice to buy the top 3 companies in the world, right? The top 3 companies in the world, then why do you want to buy the 4th, 5th best, 6th best, 7th best, 8th best, 9th best, right? I mean, I'm assuming that you guys are all familiar with analyzing companies. So Teco, I'm not sure, this group of people, I mean, the demographic of your community, right? I mean, people in this chat, they kind of know roughly how to look at earnings and everything, right, of a company.
I think depends because quite a few have not gone through any formal courses, so they may not know how to look for EPS, per share, ROE, etc. But quite a few, like especially those who are in this course here, they have a basic idea, I believe. For those, I know them. I don't know, like few others.
Yeah. Okay. So basically, right. I mean, if you guys don't know how to do it, then ask Teco. That's why you guys are in this track, right? So Teco, I'm going to push that to you, right?
Sure.
I can't share it within this 2 hours of sharing. So you have to start doing that, and when you start maybe having, so my advice is always, when you first start, right, always form a 10K position into each company. Right? Form a $10,000 position in each company before you move on to the next tranche. So for example, like let's say if you have 20K, then try to form 2 companies of 10K each, right? And let's say if you have 100K, then that's where you really have 10 companies. And if you have 100K and more, stick to 10 companies, because guys, the truth is you will never be able to keep up with so many companies. I mean, I assume all of you are busy working adults. You can't be reading 20 annual reports, 20 quarter reports every 3 months. You'll go crazy, right? And I don't think most of us have a circle of competence that allows us to buy 20 companies, 30 companies, right? You'll go mad, right? So just stick with 10 companies that you're very, very familiar with, that are no-brainers, especially no-brainers that are growing at more than 15%. That will make you very, very wealthy. Okay, so the next elephant that I'm going to share with you guys is basically.
Just a post here. I think, Jonathan, just want to thank you because I think throughout your sharing, you already actually answered a few of the questions because I asked them, I shared with them a form yesterday and they fill up and a few questions come in like, okay, as a beginner, how do I structure my portfolio and how do I really start and how do I have the conviction? I think you have really pointed out very, very well, especially with the 10K each stock. And then if you have 10K only, then split into 3 stocks. That's really great. And I don't know if it's okay. I just bring out one question here,
Sure.
which I personally also want to know from your
Sure.
thoughts, because I think conviction is definitely one thing. Like for example, whether it's Tesla, which Ken has 100% like conviction, and for me maybe Disney, but recently my conviction also shaken by their closure of theme park, and maybe my conviction in Alibaba, different stocks. But then how do we then talk about valuation? Because let's say even D-Dot, the Datadog, right? It is good company, but then how can I be convicted at current valuation? So could you share about your opinion on valuation at this current market?
Yeah, so I feel that a lot of people like think that the current markets are very, very high, and that's why they just totally dismiss like, oh, okay, I mean the current markets are high, therefore I'm not gonna buy any companies. I think that is like one of the worst thing you can do for yourself, because you have to realize that the market is the market, right? The market does what the market does. You don't give a crap about it, right? What you want to really drill down is like, is the company that you're looking at now, is it cheap or not, right? Sometimes the market can be expensive, but the company you're looking at, a high quality company, can be cheap. So you want to really look down to the valuations of the individual company. So I mean, I just share a sneak peek of my sharing tonight. Okay, I'm actually going to share about how someone can actually look at Microsoft. So just let me just share my screen. Just a second.
And for those who are keen to join John's session tonight, I think John has given me the link, right? So I'll just share in my private Telegram group so that they can also sign up if they haven't, right?
It's 8 o'clock, by the way, 8 o'clock Singapore time. Yeah.
Great, awesome.
So I think TL, I think TL asked a very good question which links to valuation, right? So TL, TL, do you have a mic? Can you come on board? Let's go through this together. TL, are you there? Do you have a mic?
Calling TL.
Okay, no mic, never mind, it's okay. Okay, TL, so maybe you can just type, right? So, okay, your concern is, not sure, is it recession, never monitor the stock price, never monitor stocks closely. When stock price go lower, you are scared. Okay, so let me just ask you, right? Okay, so let's just go through this example. Okay, so let's say if you buy a property, right, and let's say the property actually use you like $10,000 a month, right? So let me ask you guys in the group, right? So how long will it take to break even? Let's say if the cost to buy a property is 100K, and it gives you earnings of $10,000 a month, right? Let's say you lock in this tenant for like the next 20 years. That means recession or not, the tenant is going to come in, right? It's here to stay. Okay, so 10K a month. So how long it take to break even? Yes, so yeah, you take about 10 months. Okay, so I think I did a typo here. So it should be 10K a year. Okay, pardon me for that. Okay, so you can see that how long it take to break even is actually 10 years. Right, so Tia, let me ask you, right, if for example during recession, right, the price of this house, right, goes down to $50,000, will you want to pounce on this opportunity or you'll feel fearful? Right, and by the way, you have a locked-in tenant, by the way, so you will definitely earn 10K a year. Right, so TL, how will you feel? Let's say if the price of this house goes from $100,000 to $50,000, how will you feel? Why? Will you feel fearful? Yes or no? Will you feel fearful? A bit. Why do you feel fearful buying a house at half the price, and you already have a lock-in tenant for 10 years? So I'll give you some time to type. Right. So TL, I'll repeat my question again, right? I mean, if the house is going at 50% off and you have a tenant that's locked in for 20 years, right? You're for sure going to get this 10K a month, 10K a year. Then why do you feel fearful? In fact, you're getting a good bargain, right? In fact, if anything. Correct. So, how you think about companies, right? should be how you think about this. So here I already say the tenant will be locked in, right? You're for sure going to get this 10K a year, right? So there are some, by the way, this is not just an example. There are some REITs that do that as well. Like for example, Parkway Life REIT, they lock in their tenants for 10 years, right? Lock in their tenants for 10 years. And you know, I mean, if you're a shareholder of Parkway Life REIT, you're not going to be afraid at all, right? So this is the importance of doing homework, right? So when you do homework, you will not feel fearful, all right? So, you know, it's really like how it goes for companies, right? So I think for Microsoft, right, if you go and take a look at if you go and look at how they do things, how they lock in their customers. By the way, they're doing a subscription model now. So you know, the beauty of a subscription model is that, so previously last time what happens is that, for example, in year 2018, I have to find customers to sell to get, for example, like $1 billion, right? Then after that, in year 2019, you know, I have to find new customers again to hit $1 billion. But now with a subscription model, right, my customers from year 2018 will continue being customers with me in year 2019. So I start off the year with customers already. You know, it's not that I have to find all over again, right, my customers. So that's the beauty of a subscription model. Okay, that's the beauty of a subscription model. You start the year having customers already. You don't start from zero, right, and you keep building onto the customer. So that's why subscription companies are so important. Okay, so once you know, think of yourself as a business owner, right, and you don't treat the stock price or the stock market like a game, right, you'll start having the conviction to buy, and you'll buy with no fear, right? I mean, can you imagine if you're a founder of Microsoft back then? Will you be affected if the market tells you your company is worth only $10 billion? No, what? Right? You know that you're so much better. You know that you're going to grow at 20%. Then what's there to fear, right? What's there to fear? You know, in fact, if anything, if someone during a recession comes to your house and asks you if you want to sell away your property at 50% off, you know, you'll be chasing that property agent away, right? Like, you know, you won't even be entertaining the property agent. You won't even feel fearful. In fact, if anything, you'll feel angry, right? Why do you want to come and ask me to sell my house at 50% off? Right? So this is how you should feel about your companies, right? As long as they're good quality, they're recession resilient, then what's there to fear during recession, right? Because the company, the real business is still going to operate, it's still going to earn money, right? There's nothing to fear. And if I were to tell you that Microsoft is bringing in $40 billion of cash every single year in the business, 40 billion, guys, 40 B, a single company, $40 billion in cash. Now, what's there to fear? And in fact, Microsoft has more cash than, you know, it's debt right now, right? It has a net, if I'm not wrong, a net cash position of $40 billion. So if anything, they can just pay off all their debts. And, you know, in fact, if I'm not wrong, they can last at least for the next 5 years, even if they earn no money and still continue sustaining the cost that they have. Right? So when you know all this, right, there's nothing to fear, seriously. And so basically, right, this price over earnings is actually the number of years you take to break even, right? So you can see here, this is the Microsoft chart, right? The blue line stands for the stock price, all right? So you can see the stock price kind of like gradually went up over the years, and the orange line is kind of like the break-even line, right? So the break-even line shows you how long it takes for you to break even if you were to buy Microsoft now. So the break-even is really the same, right? So what we did was we take the stock price of Microsoft, we divide it by the earnings that Microsoft is earning, right? So this is really the same concept as how long it takes for you to break even if you're to buy Microsoft at a given price now. So for example, right, at this point of the chart, you have to buy Microsoft at $115. Number of years for you to break even is about 24 years here, right? So the orange line, the scale is here on the right. Okay, for the stock price, right, the numbers is on the left, right? So let's say if I'm to read here, right, stock price of Microsoft right now is $110. And if I were to buy Microsoft at this point, the number of years I take to break even is about 20.5, about there, 20.5 to break even. Okay, so I want you guys to just look at this chart, right? So this red line, right, is the number of years on average investors are willing to pay. So this red line is the number of years where is a price where investors are willing to pay to break even, right? So in general, right, shareholders of Microsoft don't mind breaking even at around 23 years when they buy this company. Okay, so when the stock price of Microsoft, or when the valuations of Microsoft, or what I call the break-even, number of break-even years go below this average, right, it's actually a screaming buy, right? It's actually a screaming buy for you to buy Microsoft, because on average, people usually break even in 23 years. But now, if you were to buy Microsoft now, you actually break even lesser than 23 years, right? Because of the valuations, right? Either because they earn more money or the stock price went down. So you can see, yes.
Yeah. So can I just check with you? Is this considered as the looking at their average PE?
Yes.
So we buy below the average PE.
Yes, correct. But for here, I kind of use yeah, correct. Yeah, yes, you're right. So looking at the average PE. So you can see here, this is the stock so-called mini crash early in this year, right? You can see stock price went down from $190 to $140. And you're getting Microsoft at a break-even rate at some point of time, even at 20 years, you break even within 20 years, right? So you break even 3 years earlier than some other investors. So this was a screaming buy, and that's how you actually look at valuations, how you determine whether you should buy a company. So everything you do here, right, is very logical, right? How you invest should be very, very logical. It shouldn't be, oh, I feel that, stock price went down, hence I can buy it. No, you shouldn't be doing that way. You should always look at, how long it take for you to break even. So how you look at buying a stock is really how you look at yourself. Let's say you have $1 billion and you want to buy a real company. That should be the way in how you should invest, right? And stocks is just kind of like giving you a partial ownership of a business. So how you should invest as a partial owner should be the same as how you should invest as a full owner. Very, very important, right? So just write down in your notes, right? How you should invest as a partial owner should be how you invest as a full owner of a business. So Rina says for shareholders, the gain is only paper gain. Unless I sell it off, then I'll have the actual gain. Do you keep buying and selling in order to collect profit? So Rina, I'm going to share with you, right? There's a lot of people saying that. Actually, a lot of people talk about this, right? Hey John, what you're advocating, buying companies and holding it for long term. Actually, these are kind of like paper gains, right? So I want to share with you, right? Actually, do you realize the world's richest man, Jeff Bezos, he's actually sitting on paper gains as well. Do you realize that he's actually sitting on paper gains? So we now want to share with you, right? There's no way you can find out when the highs are, when the lows are, and you sell them perfectly. I mean, if a company is growing for you at 20%, 30%, then why do you want to sell it away? Right? Because when you sell it away, so what? You get the money, then you have to find another company that's growing 20, 30%. Then you have to hit it again. You have to redeploy your cash. Right? Because you can't be putting your money in the bank. You put your money in the bank, it's only growing at maybe max 1 to 3%. Right? But
So,
if you don't, yeah.
You finish your sentence. I have a question here as well.
Yeah, but if you to stick with a company that's growing at 20, 30%, then your wealth is going to grow at the same rate at which the company is growing at. So, I mean, some of you may be asking, but I want to have passive income and everything, right? So what you can do is like, at the start, there's no shortcut, right? The only way to do it is to save aggressively, cut down on the expenses. That's the hard truth. That's the hard truth that no one is willing to tell you because they're selling courses and they want you to buy into them. They want to sell hope to you. But that's the truth, right? You have to find some side hustle, get that extra income, right? And that's how you can compound your wealth really, really quickly. Right? I'm not sure if you have come to my first webinar. I actually talk about how you can actually calculate how long it takes for you to be financially free, how much you need to save a month. Yeah, there's no shortcut. I mean, if you're not willing to put in extra money in every single month, then how are you going to grow your wealth? There's no way you can grow your wealth, right? Unless you can find companies that grow at 100% every single year, which is quite hard, right? I mean, imagine if you open a chicken rice shop and you have to grow at 100% every single year. Maybe yes, the first few years from one shop go to two shop go to four shop, four shops go to 8 shops, 16, 32, 64. Then you hit a plateau, right? You stop growing at such high rates. So you have to understand businesses are also real things, right? It's quite impossible for you to grow so high. Yeah.
All right. So, Jen, I have a question because, in fact, years ago, I was looking at this company. I thought on the balance sheet, on the EPS, seems good growth. And this company is actually none other than our Foot Locker, which I think we heard years ago, right?
Right. Okay.
Foot Locker. So for me, I think the question is back then, I think it was really a great business. So subsequently, I think if I were to just buy and hold, isn't that I wouldn't know what are the things I should be taking note of? Like when is a turning point I should actually cut the loss? Because right now, I think this company may not be worth investing anymore in terms of like current market. It will not grow like how Microsoft grows. But I think years ago, easy 3-4 years back, or at around that range, I think looking at number was great. So I actually had like some options position on that. So I was actually feeling happy for not buying the shares directly and hold for a period, because if I were to hold, the share price actually approached. But if I did options earlier, so my profit from this stock particular is actually profit because of options. So maybe you can share your view, like is it a point whereby we cut loss or etc.
Right.
And
so
when
I
do we
think,
know their business actually like turn bad?
Yeah, so I think actually, moving on, I think we received a question on the Word document asking us like what are the kind of industries I look at, and the industries I look at are companies that are not, that do not have a physical product, right? Companies that don't have physical product. So I prefer companies that are software as a service. So these are I call SaaS companies, or companies that can scale without needing to open new stores. Right, so let me just explain to you. I need to share my iPad screen. Just give me 2 minutes.
Sure. So let's see any other questions from the chat itself. I know we have some prepared questions like questions from yesterday, but right now if you have any questions so far, feel free to comment first, and later after John is done, I will then bring up the questions to ask him. So when the customers have changed, KC also a good company. KC, what company? What company is that? KC. Yeah, what's KC? I don't know. I have not heard of KC.
Okay, just give
What
me
else?
a while. I'm almost done.
Any other questions? Oh, so far, are you actually able to follow up? Because I think if you have no background, that might be a challenge. Because I think what John has shared is really quite in depth and also technical, and he shared really solid investing rules. Like I think he definitely sounded like a Warren Buffett to me, and he is only 25 years this year. Just imagine his wealth, his portfolio is growing like at such a high rate because he's holding a companies that is growing at like say 30%. So wow, such a very good sharing from you, Jonathan.
Okay, so I
Cloud
want to
Fairs. Okay.
I want to share
Yes.
with you guys, right? So, okay, so the traditional companies, right? This is what I call. Can you guys see me writing? Take note. Can you see?
Yes.
Okay, so these are the traditional companies, right? So let's say if this year, so let's say if in year 2010, right, my net profit is kind of like $10,000, right? So let's talk about Foot Locker. I'll consider Foot Locker kind of like a traditional company. So how does Foot Locker earn more and more money, right? Just type in the comments below, guys. What's a way? How can Foot Locker, a company that sells shoes, how can they earn more and more money? Sell more shoes, yes, very good. Okay, increase sales, right? Okay, sales. Okay, so you realize, okay, to increase sales, all right, what must they do to increase sales, guys? What must they do to increase sales?
Marketing.
Okay, marketing. Any more? How do they increase sales? What are things that are needed to increase sales? Right, you need your more stores. Yes, very good. You need to do this. You need more stores. Okay, you also need more inventory, guys. So inventory is the number one killer. Inventory is the number one killer because why? These two things are actually killers because you need more money. Right, stores in a sense like you need probably your property. You probably need some equipment as well, right? Because for example, your furniture or whatever not, right? So this is what I call high capex. Right, so these are called capital expenditure. So companies which have very high capital expenditure, right, they are actually known to not scale very well, right? So you can see for Foot Locker, let me just share back my screen. Okay, you guys can see the morning star. Okay, so what I do is that I actually compare, basically the capex as compared to the cash flow of the companies. All right, so you can see that actually, number one, right? Firstly, you can see that their revenues are actually not growing at spectacular rate, right? So when their revenues are not growing at spectacular rates, right, this is a sign that the total addressable market is actually their size, their market share is actually not increasing. All right, so let me just put down the numbers and put it in Excel so that we can see very quickly how much was it growing at. Okay, so with these numbers that we have here, right? So I'll just take this, divide by this, minus 1. Okay, so this was 11%, so on and so forth. Right, so actually you can see in year, let's take a look. So in year basically 2016, they're actually kind of like slowing down in terms of revenue growth really. So like you want to ask yourself, like, is this a company that you really want to buy? Right? Is this a company you want to buy? So the capex here as compared to basically the cash flow that's coming in, right, it's actually not very, very high. Maybe you're talking about in this year, maybe 30% of their cash flows coming in, they actually reinvest it back into your property or your equipment, right? In this year, maybe about a quarter, right? 2 divided by 8 is about 1 quarter, 25%. All right. So I want to share with you, right, very, very scalable companies, how their capex will look like. Okay.
Okay, thanks, John. I think what I did, I don't know is it a mistake because I think what I measured for local back then was actually looking at their EPS growth, which was actually pretty good looking at their EPS growth. Was it manipulated or was it like maybe they bought back a share? Yeah, shares has been reducing, so I think maybe that was the reason, right?
Yes. So for me, right, what I like to do is like I like to look at this thing called operating income. I'll explain that later.
True.
Yeah, I'll explain that later. So if you look at, for example, like companies like Visa, right? Okay, so basically you can see, wow, it's crazy. It's not even like more than 1%. So for example, like let's calculate, right? Let me bring up my calculator. Okay, let's calculate, right? How much percentage capex takes up in a maybe the latest year, right? So let's take year 2019. Okay, so 756 divided by 12,784, right? 5.9%, right? It's only 5.9% of the cash flows that's coming in, as compared to your Foot Locker, right? It's almost about 2 out of 7. So you take 187 divided by 696. Okay, it's about 26%. So you can see that a lot of money is actually being put back to assets, right? Your capital expenditure. So you have to buy a property, you have to buy your equipment, so it's not very, very scalable. And I think one very good thing you can see here, Tekko, is that Foot Locker, their margins are slowly coming down also. Like you can see the operating profit margin is actually coming down. So it means that either they're being squeezed out by the cost of the cost of their inventory, or they are selling, or general administrative expenses are actually coming up. So we talk about selling like things like marketing expenses, things like wages, right, which is your administrative expenses. These things are going up. That's why your margins are coming down. So these are all telltale signs, right? And I don't really look at EPS nowadays because I think that the net income can actually be very manipulated. So let me explain why. By the way, I mean I'm sharing a lot of stuff here. Like I mean these are things
too
that
nice. Yes,
yeah,
yes.
these are only things
Thank
that I share only my gym community. So maybe I'm not sure if we should even give out a recording. Otherwise, my gym members will be killing me.
Okay. I think we will
Yeah.
keep it private. Even if I share, maybe I will just keep it to a limited time. So for those who really want to catch it, then we should not make it public for too long. Then, all right?
Yeah.
And,
okay. So
yeah, John.
Yeah. So basically, right, in terms of Foot Locker, right, you can see that their revenues, likely these are things like your shoes, right? Your cost is like your cost of inventory. I don't think they actually sell their own shoes, but they actually redistribute. So they have to take on from the brand suppliers like Nike, Adidas, so on and so forth, right? So that's where you actually land up with the gross profit margins. Then after that, you have to pay for your selling expenses, right? Your general expenses, right? And your marketing SG&A, your administrative expenses, right? So your selling expenses are things like your advertising, okay? Your general is kind of like your utilities, and so on and so forth. And your administrative expenses are things like your wages. Okay, so the thing here is that only then you'll come, after this part, right, you'll land to what we call our operating income.
All right. I think yeah, John, you can just quickly summarize this part because I think we're also running out of time. I think they will be a lot more keen on some other topics. Then we have some Q&A also. So I think I got your point on this Foot Locker. So I would also find out more on this part. Yeah.
Okay, so I'll really just quickly wrap up, right? So basically what you have is your interest, expense, your tax that you pay to the government, then you have your net profit. So the problem with before that, you actually have your one-off gains and losses. So the problem with looking at just net profit, right, is that you can have a year, right, where you have really like high one-off gains, right? So for example, the company like Foot Locker sells away a property, then this will jack up the net income, and this will jack up the net profit, and you will falsely think that the company actually earn more money, but actually, is this sustainable? Is this a sustainable way moving forward? Like, do you think Foot Locker will actually sell their properties every single year? No, right? So this one-time increase in income, right, is what a lot of beginners will actually think that, oh wow, this company earn more money, so maybe it's good, I will invest. Then the next year, because they don't sell any more properties, they don't have any more one-off gains, then the net income will drop again. Then they actually bought the investment thinking that the company is actually increasing their earnings, but actually the company is not, right? So you can see that the purest form of earnings, right, is actually this thing called the operating income, because it really shows you, right, how well the business is doing. It only shows you it only accounts for all the revenues and the costs that's coming into the business, right, relating to the business operations. It doesn't take into account all your one-off gains and losses, which can be one time off.
Very good, very good. I think this totally remind us on focusing on the income from the business, which is operating income, not just income from, let's say, investment and other one-time. And I think this is really in-depth sharing, and in fact, this is what we have covered in most of the paid courses as well. Thank you, John, for sharing. For the beginners, you are really lucky to go in-depth to understand this concept. All right, great. So let's move on, right? I think we have covered this part. So I think the last portion before the Q&A is actually on the Singapore store, which you mentioned it's the only store Jim and yourself would buy. And share with us and how we can use like CPF money to buy that.
Okay, Tekpo, before I go to the Singapore stocks, right, I'll share about the two other elephants that I was talking about. But obviously
sure.
I won't go through very detailed, but I'll just share with you guys.
True.
Yeah, I'll just share with you guys like the overall thing. So you can see that for Adobe, right, they're actually growing really, really well. Can you see the revenues, right? Such a huge $100 billion company can actually be growing at such high revenues. In fact, their latest earnings was at 30%. They increased their operating income by 30% in the latest quarter. Right? So you can see even at the end of 2019, right, they have already secured $3.3 billion in revenues for 2020. So that's the power of the subscription model. So in a sense, you can see this is their backlog plus unbilled backlogs plus the revenues that they've collected but haven't delivered the service. So you can see there's easily 9 billion of revenues that's already secured for year 2020, right? So this is the power of subscription. So Adobe is another elephant that I really like a lot. And another one is also called Facebook.
100% Facebook, yes.
Yeah, Facebook actually grew their earnings by 100% because they were actually able to control their what we call their selling, general, and administrative expenses here, right? Which I shared just now. So Facebook is also definitely one company that you should definitely look out for. I'll buy Facebook at about $130 easily. It's a very no-brainer. And look at the number of users. Despite a lot of people say that people are uninstalling Facebook, but you can see the number of people that are actually coming in is actually slowly increasing over the quarters, right? Monthly active users are increasing. So I feel like this is really, really good for Facebook shareholders, and the advertising model is just going to be crazy and insane. By the way, they haven't even monetized Facebook, Instagram. They haven't monetized WhatsApp. They haven't monetized so many things, right? And there's one thing that they're focusing on as well, which is the VR world, which is Oculus, right? If you haven't heard of Oculus, please go and find out, right? Oculus is going to create the next Ready Player One. So can you imagine a virtual world where Facebook actually put down advertising banners in a virtual world, in a virtual building, right? It's free, it's free to it's almost free for them to just put all these advertisements in a virtual world, right? So these are my 3 companies that I really want you to really absolutely analyze the hell out of them so that you can be ready to take advantage. These are the only 3 elephants that are growing at more than 15%. In fact, I think 15% is a conservative number, right? Some of them have been growing at 20% quarter on quarter for their latest earnings results. All right, so next. I'll talk about this company called iFast. How many heard of iFast before? So this company called iFast. So they're actually known for this platform called FSM1. Right, iFast, they're known for FSM1. So in fact, I actually think that it's only wise, it's very smart of you guys to actually put your money into iFast, because for your CPF, right, they're only paying you out for like 2.5% for OA, right? So why not just invest your money into something that's growing at 30%, right? 20 to 30%, yeah. So iFast, in fact, recently they actually reported a really good results. All right, so I'm just going to go through some things here. Okay, so you can see this is a AUA of iFast. AUA means what? Asset under administration. So meaning, by the way, iFast is a platform, it's a brokerage platform where people can actually go onto their platform to do dollar cost averaging. They can actually subscribe to these dollar cost averaging programs to buy maybe some shares of S&P 500 or STI or some other ETFs. All right, so I think there's been a rise of passive investing over the years, right? More and more people are getting very educated, and iFast is actually benefiting a lot from that. So you can see over the quarters, right, iFast has actually been getting a rise in terms of the amount of money that they're managing for individuals, not just consumers, right? Consumers is indicated in the red chart here, but also in businesses as well, B2B. And you can see basically during the market sell down, there was actually a drop in the AUA. However, right, they were able to earn more money. Why? Because of this thing. Let me share with you. It's a bit wordy here, so somewhere around here. Right, so it's basically this thing called your net revenues, right? So their net revenues grew by 24.8%, and this actually, so actually the revenues actually flowed down all the way to the profits, because that's really, think about it, right? If today, right, iFast were to take in 1 million more people, right? What do you guys think? Do you think iFast will incur more costs, or they'll incur minimum costs? Just type in the chat below, right? Let's say if iFast, right, they were to take on 1 million more customers today, right, on the spot right now, right? Do you think they'll take on more costs or minimum costs? Right, so Gabriel says minimum cost, Wei-Fu says minimum cost, right? So yes, you guys are right. So they'll actually take on minimal cost, right? Because what is the cost of me taking on an additional customer? Really nothing, right? Maybe I need to have more data server, but how expensive can my data servers be, right? Because I already invested into my whole infrastructure. I already paid my coders to actually come up with a platform, right? So that's the beauty of a platform company. But unlike Foot Locker, if I want to increase my revenues, right, take on more customers, I have to have more money. I have to invest more money into my stores, invest more money into my inventory. But for iFast, there's no inventory at all. There's no storefront at all, right? In fact, everything is online. It's so seamless. So you can see that their net revenue grew, right, because basically that they have an increase in subscription. So let me show you guys. Okay, so inside the latest quarterly release, they say that the revenues was up 40.4% because of an increased investment subscription from customers in ETFs and stocks, and service fees arising from because sometimes when you want to buy in US companies, you have to change, right? You have to change your currency from Sing dollars to US dollars, and iFast is actually doing this on their platform. All right, so they actually earn in terms of their forex fees as well. All right, so you can see iFast has absolutely phenomenal growth. All right, you can see revenues grew by 20.8%, and if you were to look at the profit before tax, is actually 20.9%. But this is operations, including operations in China. So operations in China is actually kind of like kind of loss making at some point of time. All right, so if we look at the overall performance of this company, we can see that they are actually growing at 20.9% every single year. All right, and I feel very hopeful with for this company, because they are actually doing the right things. I don't know, if you try to go and open an account with OCBC, DBS, and iFast, you will see that the customer support is totally different. I feel like they're kind of like a SaaS company. They are very customer centric. right? So iFast is really one company that you guys should really look out for. And I think what they do is really it's not hard to understand, right? Just go and look through their website, what they offer, what kind of products and services they offer. It's very easy to understand, right? Basically, they're trying to cut out the middleman fees. They're trying to bring down lower fees to customers. And in return, customers put money with them and they're able to earn an interest on the customer deposits, right? And which is kind of free money. Yeah, so in summary, right, in US, I'm looking at flying elephants like Facebook, Adobe, Microsoft. Okay, these are companies that can really help you grow well. And also in Singapore, right, I will use my CPF to buy iFast. Right, for those who are the younger crowd, who knows, this company may even pay off for HDB next time if you let this company compound for you your money for you for 5 to 10 years. Just consistently invest in iFast. I think it's a really great company.
Great. Thank you so much, Jonathan, for your sharing, and thank you for going beyond to even 1 hour to like close to 1.5 hours right now. And I hope you still have some time. Let's keep it to maybe another just 10 minutes, 15 minutes maximum. So I know your time is also precious to answer some of the questions. I'm really thankful for all the participants like who stay on, actually, like majority actually stay on even till now for the extended session. So yeah, I think any other questions from live question? If not, we can go through some of the prepared question which John has also gone through it, right?
Yeah.
Any questions here? If not, I think let's jump straight to the prepared questions, right?
Sure.
Yep.
So let's go through the questions. These are some of the questions that I saw.
Yep.
So what is your portfolio hedging strategy? So for me, right, I think it makes sense because for me, right, I'm kind of like heavily invested in the markets right now. So it makes sense for me to hedge my portfolio, right? Because I really think based on how US is handling COVID, and if they don't, they don't solve it within by November, then winter is going to come. As in winter, as in not the Game of Thrones winter, but literally winter, where there will be snow, the weather will become cold, right? And that's where the virus might be easier for a virus to spread again. So I'm looking at this thing called VIX. So let's say if the VIX goes to the neighborhood of maybe $20, I'll start buying some puts to hedge my portfolio. Basically, I'll buy maybe 1 to 3% or 1 to 5% of my portfolio, and I'll hedge it in buy puts. So this is kind of like my game plan, right? So there are two things that can happen, all right? So two things can happen. So the first thing is number one, right? The markets rally, right? And if the markets rally is fine, right? I will lose 1 to 5%, which is fine. But because I'm so heavily invested, right? I'm maybe like 80 to 90% invested right now. My stocks, which make up 80 to 90% of my portfolio, right, will actually more than cover this 5% loss. Right? It will more than cover this 5% loss. But let's say if the markets drop, right? Markets drop. And if you guys understand how buying puts work, right? If you buy out of the money, and when the volatility is low, and if the market crashes down by 50%, you can actually make 30 to 60 times your money, right? 30 to 60 times your money, right? So my hedge will give me about 30 to 300%. Basically, it depends on how much I hedge, either 1% of my portfolio or 5%, right? So give me about 30% to 300% cushion on my portfolio. So to me, it's kind of a win-win situation, right? Either ways, whatever happens, I'm going to be safe, right? Markets go down, my hedge will cover me or help me save some money. I can cash out and use that money to buy more stocks, right? And if the market's rally, my hedge lose money is fine, but my stock prices, the growth companies that I hold will easily grow more than 5%. So I won't be afraid of that 5% loss in my portfolio, right? So that's just how I look at things. Next, what are some criteria that you use to filter out high growth companies? So I think I shared a lot just now. So some of these things are like companies that don't have a physical, that don't need a physical person to close a sale. So for example, companies like ServiceNow, right? They can just implement their solutions over the internet without having to a physical customer. So I want to share with you, like for example, like AWS also. Right. Let's say if today I'm a customer and I want to buy some of AWS solutions, I can literally just buy offhand, like right now. Like Amazon doesn't have to send a sales rep to come into my office to implement these solutions, right? Everything is done over the internet, right? So this is kind of what I like about what I call SaaS companies, right? Software as a service companies, where the fulfillment of the product is done not in a non-physical manner, right? So these are things that are traits of growth companies that are asset light, doesn't have high capex, companies that are in a huge total addressable market. So I saw some of you asking me about Master and Visa. Master and Visa also are no-brainer companies. They're also flying elephants, right? So companies in these industries, right, the fintech industries will never go wrong. Companies in the cloud industries will never go wrong. I will not bank on BioLife industries because seriously, a lot of people are rushing to buy companies that can potentially develop COVID vaccine. I feel that the fact that they're going to develop a vaccine is the reason why you should never buy the company, because if a vaccine can cure people, then I mean, after everyone gets cured, then how are they going to earn money? No one's going to buy the vaccine, right? This is what happened to Gillette, right? Gillette Science. If you study history, this is what happened to Gillette Science, where they actually produced a cure for hepatitis A or hepatitis something, right? So, after they produced a cure, the company started, earnings started dropping, right? Because when people are cured, they don't need the medicine anymore, all right? And, I always want to ask myself, right, what's a company that can go consistently for the next 10 to 15 years and not just that a few months or 1 year selling COVID vaccines, right? That's so short term, right? We don't want to think so short term, right? You don't want to chase after fast money. Chasing after fast money will bring you nowhere but to get short term failures. So you really want to focus on payment industries, fintech industries. You want to focus on cloud companies or companies that use the software as a service model or the subscription model to run their companies, right? These are companies that you want to focus on. Okay, how do you identify small and growth companies in the US and Singapore? So to keep things short, I don't think I have time to really go through everything. To keep things short, use a stock screener and literally go down one by one down the list. I mean, seriously, there's no shortcuts. There's no shortcuts to success, right? I'm going to show you there's how we actually look for companies. We really go down line by line. Look at the companies, check out what they do. There's really no shortcut. Okay, so let me just try to find something.
And I like this quotation on your screen as well. What drives me is the immense satisfaction when I break the financial shakers of people. It could be that college loan, that extra time, or even eternal freedom. Pray more, help more, save more.
Yeah,
Very nice.
It keeps me it keeps me going on and to always remember what I stand for. Yeah. I mean, who comes on a weekend, spends their time and talk about these things? You have to be.
And who stays on, right? Who stays on after an hour and a half? It's you guys, man. Awesome. Right? That's like one third of my members here. Awesome. Thanks for your time.
Yeah, you guys
let's just correct. Let's just take 5 minutes more to finish up.
Yeah. So literally this is like my screener. I just screen based on companies and just really go down one by one. One by one.
Very impressive.
You go through your industries. For example, if I'm not familiar with pharmaceutical, then I just filter them out. Then I just go through them one by one. This is the hard work that that's behind all this research and actually think about it. It's very interesting when I look at companies. I look at myself reading a storybook. I listen. I understand how the companies why the CEOs want to start the companies. I understand how this company is solving a problem in the world. And write this down, right? I want you guys to write this down. The amount of wealth that your company creates, right, is proportionate to the size of the problem that they solve, right? So the bigger the problem they solve, right, the more wealth they'll create for you, right, for these companies. So the wealth that your company creates is actually directly proportional to the size of the problem that they solve. All right, just write that down. Very, very important. So this is how I identify small companies. I filter them by the market cap. But nowadays, I don't really do that anymore because there are really big SaaS companies that are growing really well. You have your flying elephants as well. So doesn't mean you need to go for a small company to achieve really good growth, right? So that's kind of a wrong belief, right? So there's another question. During a time when interest rates are extremely low, there's huge money printing done by the Fed. Do you see the effect of inflated asset prices becoming a new norm? And how do I wrap my head around this? All right, so actually to understand this, right, you have to really go back all the way to the Great Depression where countries started printing more and more money. So I'll just share with you guys what are my thoughts, right? So, okay, so the number one winners, right, in this climate is that winners will be business owners, right? If you look back at the Great Depression, right, when countries started printing out more monies, right, the people or the big losers are the people who are salaried workers because their pay don't get increased as fast as inflation, all right? But, you know, for businesses, when you sell your products, all right, or when you sell your service, right, you can actually increase your products and services according to inflation, right? So for you to make sure that your money don't erode, right, the best thing you can do for yourself is to actually invest into assets, right? Assets that are generating cash, assets that are, you know, being used by other people. So, you know, you want to really invest into companies to keep up with inflation. And yes, how I think is that prices of and because, you know, because your prices of your products and services will increase, right, this will translate to companies increasing their earnings, right? So when company increase their earnings, right, they're going to have a increase in their valuation. So you can expect stock prices to actually go up. It's actually very, very logical, right? So yeah, this is how I see things moving forward. Okay,
Yep.
my opinion on
Sounds
the
good.
economy.
Sounds good. I think you have shared the beginners good plan. You have shared that about the 10K, 3 stores, and then growing company. You have shared that as well as a similar question. Strong coefficient, you have covered that. What strategy to pivot through the crisis? I think all you have
This is
shared is actually
your
the strategy.
elephants, right? These are your three
Yep.
elephants and your iFast using your CPF to buy iFast. Which sector I've actually shared.
Yeah, you shared sales company and all that.
Yeah,
Criteria you have shared. Facebook, PayPal, all-time high. I think you have shared about the valuation as well. So
yeah.
yep.
Look at, okay. So you have to look at I mean, you're looking at just the stock price, but you realize that, you know, stock price is not everything. You have to look at valuations. So for example, right, let me take a look. Let me show you the example from Microsoft. Right, even though the stock price actually went up, can you guys see here the stock price went up? But the valuations actually were cheap, right? So doesn't mean stock price got means you can't buy. You have to look at valuations, right? How is this possible? Stock price got, how come valuations can become cheap? Because your earnings increase, all right? So you have to always put things into perspective. Don't always just focus on the stock price, right? Look at stock price in relation to how much the companies are earning, right? So I hope this can give you some perspective. Okay, what is the industry company that can benefit and for investors to look out for? So I'm a firm believer not to really buy companies just because of COVID, right? I would definitely avoid pharma companies, or avoid companies that are doing masks. It's like, I mean, seriously, can you imagine what will happen to them if COVID is over? They're going to die, right? There will be no more demand for masks, right? So I want to look out for companies that thrive during these COVID industries, right? Companies that do not need physical presence to make a sale, okay? So what is H shares, by the way? Is it Hong Kong shares?
I'm not sure actually.
Yeah, maybe if you are the person who asked this question, could you just maybe clarify?
Comment.
You know, what is this H shares that you guys are talking about?
Meanwhile, let's move on to the next question then.
Okay, so let's go to the next one. How viable is it to use CPFIS to buy stocks in Singapore, and how much of it should we use as not to overdraw? Honestly, I actually have no idea about CPF because I'm not a CPF expert. I mean, let me be upfront first. I don't know if Tepo is a CPF expert or there's a CPF
I can
expert.
do a quick sharing. I mean, this is very basic information that all of you should know. Like for example, the amount in your OA, right? Anything above 20K, you can actually use
right?
that to invest in stocks, but it's not everything. Let's say if you have 40K, it's not about the 20K above the 20K. It's actually the 35% of the additional amount from that 30 the OA can be invested into the stocks. So there's some articles on it. It's pretty easy to find a Google search, then you can see the results, but basically it's not everything. So it's actually pretty safe to use the amount that you can invest in stock market to invest in stocks. And there's a small portion for investing in gold as well. So I think it's overall pretty safe, and you would not actually like overdraw from your CPF. That's in my opinion. And if you're buying into great companies, actually 5-10 years later, and you can't touch it in 5-10 years later, you have to touch it only when you're 50, 55, right? So by that time, if you're investing in great companies, it's more than likely that you will do better than your fixed 2.5%. So that's my quick answer.
Yeah. So I think you definitely have to use your if I'm not wrong, you can't use CPF. Oh yeah, you have to use your OA money to invest in stocks only. Yeah, you can really use that. So
Or the amount in SA but above 40K.
yeah, yeah, yeah. As you guys know, I'm really not a CPF expert. I really spend more time really
Yep.
trying to
I
find
think I
out.
think
Yeah,
Chenko is also one of the
your
experts in
company.
this topic, so we can bring it
Yes.
offline and continue the chat in our Telegram. So that's all. Any other questions? If not, I really appreciate Jonathan's time for close to like 2 hours
Oh,
session.
just can I just cover one more? Do you guys have
oh,
time
sure,
for
sure,
one more
sure,
thing?
sure. Yes, definitely. I'm happy,
Yeah,
but yeah, let's continue.
just one more thing, just one more question, right?
Yep.
I saw this, right, and I forgot to address this. Like you guys asked about, do you diversify by buying gold or bitcoins, right? So okay, I think Bitcoin I don't have to explain anymore. Like why you shouldn't buy Bitcoin? Because it's not backed by assets. It's kind of like you're trying to. I mean, the supply of Bitcoin is limited. I understand that, but it's really at the end of the day, is your value of Bitcoin is based on the trust of people, but it's not backed by governments as well. So for gold, I think it's very funny, right? Because okay, I like to think about gold as as a solid object, right? So think about it, right? 100 kg of gold, 100 kg of gold is equivalent to 100 kg of gold in the future, right? 100 kg of gold now is equals to 100 kg of gold in the future. So you think about it, right? Gold is an asset that doesn't create value. No matter how people try to argue or whatever, not gold is an asset that doesn't create value. There's no value creation, right? You think about it as compared to companies, right? Let's say for Amazon, for Microsoft, they're actually creating an output, right? They're creating output like earnings, they're creating output like dividends, right? So they actually create some sort of value. And when they sell products and services, they create value to society, value to businesses to actually have more productivity in their work, right? So but for gold, there's no such thing, right? Gold is just gold. It sits there, it does nothing, it creates no value to society,
I
it
think
does
this is a
nothing,
very interesting one,
doesn't
John,
solve
because I
problem.
think
Yeah.
I think this one I can add a bit because I think what I see gold as a value is that it give people to feel that it's safe because it's precious
Yes.
metal and it's limited. So I think the value is not in direct value to consumers. You can use it or you can eat it, you can't. But the value is I have a tons of gold, physical gold or gold ETF. I feel safe because that is like, yeah, I have it. So I think that is the value that is giving to people in terms of greed and fear in the market. So maybe that would eventually potentially drives the price it go up, especially in the current market, which is volatile, and hence we can see the gold price going up. And in the next few years, I do see also some other crisis, maybe like sovereign bond crisis, all that could be also happening, or some other a lot more unknown factors, and that's why people will turn their funds into gold, which is a fixed like a precious matter. So I think that's a value it give people, not a direct value, which is totally right, John. Yeah.
Yeah. So I think the key thing here I'm trying to emphasize is that gold as an asset, there's no output, right? You buy
Yep.
properties, the output is your rental income. You buy companies, the output is the products and services they create, the value they add to society. So there's no value creation for gold. So the only way. So how I see gold is kind of like precious art, right? How I see gold is kind of like precious art, right? For example, like if I were to buy an art for like $20 million, right? And how can I make a profit from it? Is where someone else appreciates the art more than me and offers to pay $30 million, correct? So for gold, it's the same, right? When I buy gold, for example, I don't know what's the price now. Let's just give an example, maybe $80. Right? If I buy 1 gram of gold for $80, and how I'm going to make money is where in the future someone values gold more than me, right, and is willing to pay it at $100. So this is what we call value transference, right? There's a transfer in value, right, but there's no value creation. All right, so you can't be rich from value transference because there's just so much as to how much people perceive gold to be precious, right? I mean, it's just going to go up. I mean, there's a certain limit, right, as to how much people can hype up how safe is gold and everything, right? But for companies, right, when your company is growing at 30%, 40% year on year, there is no way anyone can, rebut that, you're creating value and that that let's say you grow, let's say 100% in your revenues, right? You can't say that I'm not worth 100% more, right? So that is why historically, if you were to compare investing in gold versus the S&P 500 in the same period, right? Investing in companies would probably will actually make you so much more wealthier. And for me, right, I feel like if I had the chance, right, to own all the gold in the world versus all the companies in the world, I think I'd rather own all the companies in the world, right? Because I really think that companies actually are productive assets. They actually create output, right? And I have more confidence in owning such in companies rather than just gold, right? So I think Warren Buffett joked about it, where humans work so hard to dig gold from underneath the earth, and at the end of the day, they bury this gold underneath the earth and hire security guards to guard this gold. So seriously, I mean, if given a chance, I would rather buy all the companies than buy all the gold in the world. And yeah, the key here is about value transference versus value creation, right? You want to buy things that create value.
Yep. Thanks, John. I think you are a go to us because you are really creating value with us for the last 1.5 hour plus. So can't thank you enough, because a lot of members here, they paid $1 to join my club, and they're lucky. And in fact, it's only a few numbers of people that actually sign up through your webinar. And that's why we got a chance to win this prize, to have this precious coaching call with you. So I really still encourage people to attend to John's sharing. I think, John, I heard that you have a subsequent webinar also, right? Including tonight, 8 p.m. There's one. And then subsequent weeks, you are going to have more webinars for public to listen and learn more from you, right?
Yes. So for the next one, for this coming tonight, we have actually 8 p.m. webinar. And also for next Saturday, we're going to have another webinar. In that webinar, I'll be actually introducing my class, because over the 3 webinars that I've been conducting, a lot of people have been asking about how they can join my class. So do note that I'll be actually talking about my class at the end of the session. If you guys are keen to find out more, what do I do, what the growth investing community do, you can actually check this out. I think in the meantime, what you guys can do is to follow me on Instagram. So just give me a second. So I actually post a lot of things into my mailing list and my Instagram. So I really highly encourage you guys to actually follow me, and to also take part in my mailing list. So my mailing list is really high quality content. I don't spam all the mindset stuff, all the nonsense. I mean, I do talk about mindset stuff when it's very, very important. I do put some effort to make it good. I also announce when I have webinars, right, to share with you guys. So this is, if you guys want to receive notifications, or to be the first to know, let's say if I have webinars, then I think you should sign up for my mailing list, right? If you just want to see the content I share every day, right? I share a lot of Instagram stories actually. So just follow me on Instagram at Jang the Investor. So why Jang? Because my name is Jonathan Ang, and my friends call me Jang, and it's quite a nice name. So yeah, I call myself Jang. Okay, so this is how you guys can follow me, and I really hope you guys got benefited from this session. So actually, could you guys just help me type in the comment section below how you felt about today's webinar, so that Tekpo and I can actually I mean, there's just me and Tekpo trying to let people know how to be educated in investing. And there's only just so much we can do, but together with you, we can help more people to get started investing the right way. And just by letting us know how we feel about this session, we can share with the public basically how our sessions are like. We can give a rough sense of people, like what they can take away when they come for our sessions, so that we can help more people together. Okay, so just type how you feel about the session today, all right, so that Tekpo and I can do some screenshots, and we can actually share our content more with people out there in the public.
And do thanks Jonathan here, just comment or send your crabs to Jonathan here. I think he's really spending a lot of efforts, not just his time, but beyond these 2 hours, he actually prepared a lot. Like last night, and we chatted like weeks ago on how we can actually bring the best value, and not just for myself and for this community here. Jordan, thank you for your clap. And any other questions, any other feedback, comment, let us know. If not, I definitely encourage you to follow Jonathan on his Instagram, especially his stories. That's really tons of information there. And thank you, Mary. Anything else? Any other comments?
Just give me a while. I want to take a class photo.
Nice. Come. Let's do it.
Okay, how do I do that? We just do a thumbs up. All right, so I need you guys just to give me a thumbs up emoticon, so that we can take a kind of like a class photo. All right, so 3.
And your most awesome expression.
Okay, thanks for opening on your webcam. Okay, just give you a thumbs up, right? 3, 2, 1. All right, thank you guys.
Best.
Right,
Well start for my
class
long
photo.
weekend, right?
Yeah.
Awesome. So yeah, that's it. So that's it. See you guys back in the Telegram. If you have information to share, feel free to share your notes over there. And thanks, man. Have a great long weekend. Happy Hari Raya, Selamat Hari Raya Puasa for those who are celebrating.
Oh, yes.
All right. Welcome, Amanda. And have a great break, Jonathan, before your session later.
Yes, I'm having a long day today. Yeah,
yes,
I hope I'll be able to get the energy.
Definitely,
up,
man.
Yeah,
You always do. All right, cool. How come people are still staying? How come people are still staying? That's cool. It's ended. It's ended. All right, take a break, and continue to research more on all these stocks. And ServiceNow, NOW is one stock I'm also researching more. And whatever Sean has mentioned, iFast, I'm kind of like new to it. I need more time to research as well. That's all. No more encore, no more round 2. 27 people are staying. I don't know for what. you guys are waiting for our private chat. Is it for like, hey John, any tips for next week or what? No. We had a chat already. So thank you. Bye bye. See you guys.
All right, see you guys. Take care.
Bye bye.
Bye guys. Take care. All right. Very good.
Very good. How come people are they actually already fall asleep or tell people? John, maybe we can stay for a quick few minutes. I just
yeah, I can do a breakout room so that it's only me and you.
Oh yeah. I don't use Zoom as frequent because we use Hangout more for work.
Oh, okay, interesting.
Yeah.
Okay. Let's go.
Cool. So that one ended, is it?
No, they're still there, but they can't hear us. We are
okay. You can actually end it also can. So I think super, man, seriously, I think you're giving so much more information. I was shocked to know like you're giving so deep. Even for the Q&A, you're also going so deep. By the way, we can you ended your recording. I think we can end the recording also.
Okay.